Think about this for a second. You've got, let's say, an exceptional piece of art, really valuable, and you want to find the right collector. Someone who gets it, willing to pay what it's worth.
Right.
But there's no Sotheby's, no Christie's. It's just you trying to find that one person. Or imagine you've got this amazing medical tech idea, could save lives, but you're just, knocking on doors, hoping someone with cash and vision walks by.
Sounds incredibly difficult, yeah. And that's really the core problem, isn't it?
Exactly. That's the challenge we're diving into today.
Absolutely. In a complex economy like ours, efficiently connecting those with surplus capital or the money to those who actually need it to, grow, innovate, achieve goals.
Yeah.
It's paramount.
Without a good system, it's just chaos.
Yeah, not just inefficient, but really risky, uncertain. So that's why we're taking this deep dive into the Canadian securities industry today. We're focusing specifically on the crucial role of financial intermediaries.
Think of us as your guides for this. Our mission really is to unpack how these financial matchmakers work. We'll explore, in detail how they connect people, institutions, even governments who have capital, with businesses and projects that need it.
The whole goal being to make money flow smoother, more transparently, and importantly, safer for everyone involved.
Yeah, safer is key. And to do this, we're drawing on a pretty comprehensive foundational text about the Canadian securities industry.
That's right. It lays out all the participants, the different kinds of intermediaries doing the connecting, and crucially, the big trends shaping the landscape right now in Canada. It gives us a really solid framework.
So whether you're just curious about how this whole financial world ticks, or maybe you're thinking about future money decisions, or you just want to grasp the system underlying our economy.
Yeah.
This deep dive is for you.
We'll break it down, provide clarity, valuable insights, but hopefully without getting, bogged down in jargon.
Okay, let's really get into it then. Why exactly are these intermediaries so indispensable? What's the fundamental need?
Okay, so at the most basic level, the financial system is all about channeling capital, taking it from those who have extra, the suppliers, and getting it to those who need it for something, the users.
Suppliers and users. Simple enough.
Right. And the source gives a good example. Think about a parent maybe putting money aside each month into an RESP for their kid's university. That parent, supplier of capital.
Okay, makes sense. Saving for the future.
Exactly. Now, on the flip side, picture a tech startup, maybe out in Waterloo. They've got some cool AI application, but they need, say, $5 million to scale up, hire people, actually get it to market.
Right. They need funding. They're a user of capital.
Precisely. And that's the gap, isn't it?
Yeah, it's not like that parent saving for tuition is going to just bump into the AI startup founder at the coffee shop and hand over their RESP money.
Highly unlikely. And that's exactly where the intermediaries come in. The source calls them matchmakers, which is a pretty good description. They are the specialized firms, the institutions that bridge that gap between the suppliers and the users.
So they're more than just introducers then?
Oh, much more. Without them, both the parent and the startup face huge hurdles. Think about search costs. How does the parent find good investment opportunities that fit their goals, their risk tolerance, their timeline?
They probably don't have the time or expertise to research hundreds of companies.
Exactly. And likewise, how does the Waterloo startup find investors who not only have the $5 million, but also understand their niche tech and are willing to take that early stage risk?
That sounds like a nightmare, honestly. Just finding each other would be incredibly inefficient.
It would be. And then even if they do find each other, think about agreeing on the terms. What's a fair price for a piece of the startup? What's a fair interest rate on a loan?
Yeah, negotiating that from scratch without any kind of standard or expertise, it could get messy. One side might have way more information or power.
Precisely. And then there's the actual mechanics of the deal, a settlement. How do you make sure the money actually changes hands securely? That the investor gets their shares or their bond certificate?
Right. The paperwork, the actual transfer.
Intermediaries handle all that. They create the standardized rules, manage the complex admin and legal stuff, ensure the assets move smoothly. They reduce all that friction.
Okay, so they make it possible for the parent to focus on saving and the startup to focus on building without getting lost in the financial weeds.
Exactly. More trust, more efficiency, more confidence in the whole system.
Okay, it's crystal clear why we need them. Now, the source points to investment dealers as being really central, the core intermediaries in Canada. What makes them so pivotal?
Investment dealers really are at the heart of it in Canada. They do a whole range of things essential for that capital flow, serving everyone from, regular individual investors to massive institutions managing billions.
And the source breaks them down into different types.
Yes, it helps clarify things. There are basically three main types of investment dealer firms.
All right, let's unpack those. First up, retail firms. These are the ones most of us probably deal with, right?
That's usually the case, yeah. Retail firms cater mostly to individual investors. And even within retail, there are two main flavors. You've got your full-service firms.
Full service meaning advice.
Exactly. Personalized advice. They look at your situation, your goals, how much risk you're comfortable with, and they build a plan, recommend investments, manage things ongoing. Think of places like RBC Dominion Securities or CIBC Wood Gundy. It's very relationship-based.
Okay, so tailored guidance, hand-holding if you need it. What's the other type of retail firm?
The other type is self-directed, or sometimes called discount brokerage platforms. Think Questrad, Wealthsimple Trade, that kind of thing.
Ah, the DIY option?
Pretty much. They give you the tools, the platform to buy and sell stocks, bonds, ETFs, whatever, on your own. They don't give advice, so their fees, like commissions per trade, are usually much lower.
Makes sense. Good for people who are comfortable doing their own research, making their own calls.
Exactly. It's about lower cost and more control for the investor.
Okay, so full service versus self-directed under the retail umbrella. Then we have institutional firms. Who are they serving?
Institutional firms are dealing with the big players. They handle large volume trades for clients like pension funds, think CPP Investments, or OMERS mutual fund companies, insurance companies, you name it. Big organizations trading big blocks of securities.
So we're talking massive transactions here.
Huge. The source mentions an example like a Toronto dealer buying, say, $50 million worth of government bonds for a pension fund. They have the specialized setup and market access for that scale.
Right. Completely different world from me buying a few shares on an app.
Right.
And the third type, integrated firms.
Integrated firms are basically the biggest players. They combine everything. They have the retail side, the institutional trading side, and they do underwriting.
Underwriting. That's helping companies issue new stocks or bonds, right?
Exactly. Helping companies and governments raise capital by bringing new securities to the market. A good example of an integrated firm is TD Securities. They've got a big retail brokerage, a major institutional desk, and a large investment banking division doing those big deals. They cover the whole spectrum.
The true one-stop shops of the securities world. Okay, so we know the types of dealers. How do they actually make money? What are the main ways?
There are two fundamental ways, and it depends on whether they're acting as an agent or as a principal.
Agent versus principal. Okay.
When they act as an agent, they're basically a broker. They're just facilitating a trade between a buyer and a seller, connecting them.
And for that connection service?
They charge a commission, just like a real estate agent, as the source points out. The agent helps sell your house, finds the buyer, handles the deal, and gets a commission, maybe, 3% or something.
Right, a fee for the service.
Exactly. For an investment dealer, that commission might be a flat fee per trade, or maybe a percentage of the trade value, especially for bigger ones. That's the agent model.
Okay. And the other way, acting as a principal.
Right. When acting as a principal, the dealer isn't just connecting others. They're actually using their own money, their own capital, to buy securities into their inventory. Then they sell those securities to clients later.
Ah, so they're taking on the risk themselves, holding the stock or bond.
Yes, they are. And they make money from the spread.
The spread, what's that exactly?
It's the difference between the price they buy the security at and the price they sell it at. The source uses the currency exchange analogy, which is perfect.
Okay, yeah.
Think about a kiosk at the airport. They buy US dollars from you at, say, $1.35 Canadian. Then they turn around and sell those same US dollars to someone else for $1.37 Canadian. That 2-cent difference, that's their spread, their profit.
Got it. So a bond dealer might buy bonds at one price and sell them to me at a slightly higher price, and that difference is their income on that trade.
Precisely. That's the principal model. Profit comes from the spread.
That's a really clear distinction. And the source stresses something important for investors here, right?
Yeah.
About understanding the pricing.
Absolutely critical. You, as an investor, really need to understand if the price you're quoted includes an explicit commission fee, meaning they acted as an agent, or if the firm acted as a principal and their compensation is built into that spread.
Because it affects the total cost you're paying.
Exactly. Don't hesitate to ask your advisor or the firm, how are you being paid on this transaction? Is it a commission or is it in the price? Transparency is key.
Good advice. Always know what you're paying for. Okay, let's peek inside these dealer firms. The source mentions a typical structure: front, middle, and back offices. Can you break those down?
Sure, it's a common way to think about how these firms operate. The front office is basically the client-facing part.
Where the action happens?
Pretty much. It includes investment advisors working directly with clients, understanding their needs, recommending things. It includes the traders who actually execute the buy and sell orders in the market. And it also includes investment bankers, the ones focused on raising capital for companies, doing those big IPOs or bond issues.
Okay, so relationships, advice, trading, deal-making, that's the front office. What about the middle office? Sounds less glamorous.
Maybe less glamorous, but absolutely vital. The middle office is all about risk management and oversight.
Keeping things in check.
Exactly. You've got compliance in there, making sure the firm follows all the rules and regulations. You've got the legal team managing legal risks, and the finance department managing the firm's own money, budgeting, accounting.
Right.
They're the guardians, ensuring everything is done properly and legally.
Essential stuff. And the back office?
The back office is the operational engine room. They handle all the administrative and logistical heavy lifting after a trade is made.
Like what specifically?
The big one is trade settlement, making absolutely sure the right securities go to the buyer and the right cash goes to the seller. They also handle all the record keeping, keeping track of every transaction, every client account. They're the ones making sure all the I's are dotted and T's are crossed operationally.
The unsung heroes, making sure it all actually works behind the scenes.
You could say that, yeah.
The Source uses a Shopify trade example to tie this together. Can you walk us through how a simple trade flows through these offices?
Sure. Let's say a client wants to sell 500 shares of Shopify. They tell their advisor front office, the advisor puts in the order, and a trader, also front office, executes it in the market.
Okay, trade done. Then what?
Then the middle and back offices kick in. Middle office compliance might review it, just to check it aligns with the client's profile and rules. Maybe not for every trade, but they have oversight. Then the back office handles the settlement. They make sure the 500 Shopify shares leave the client's account, and the cash from the sale arrives. This whole settlement process usually takes 2 business days after the trade. We call that T+2.
T+2.
Yeah.
Okay, so front office does the deal, middle office checks it, back office settles it. Makes sense how they all connect.
Exactly. Every part plays a role.
Now, investment dealers are central, but they're not the only game in town. The Source lists other key financial institutions. Let's touch on those. Schedule I banks first, the big ones we all know. What's their main job and key feature?
Schedule I banks are your RBCs, BMOs, TDs, etc. Their core job is taking deposits, making loans, mortgages, personal loans, and also selling investments. The everyday example is just depositing your paycheck or getting a mortgage from one of them.
Pretty familiar. What's the special rule about them?
The ownership rule. No single shareholder or group acting together can own more than 20% of their voting shares. It's designed to keep ownership spread out for these really important banks.
Interesting. Prevents too much concentration of power. What about Schedule 2 and 3 banks?
These are basically foreign banks operating in Canada, either as subsidiaries, Schedule 2, or branches, Schedule 3, with more restrictions. They do similar things to scheduled banks, but often focus more on corporate and institutional clients, less on the general public retail side.
So more business to business.
Often, yeah. The Source gives an example like Barclays Bank Canada providing a big loan to a mining company. Schedule 3 banks are even more focused, often on wholesale banking for very large clients.
Okay. Then we have credit unions and Caisse Populaires. How are they different?
They're member-owned cooperatives. Big difference. They offer similar services, deposits, loans, investments, but their focus is very much on serving their members and local communities.
Like the example of a teacher's credit union offering special loan rates.
Exactly. And their governance is key. They're accountable to their members, who often have a say in how things are run. It's a different philosophy.
More community-focused.
Yeah.
What about trust and loan companies? What's their special thing?
They can do many bank-like things, take deposits, make loans, but their unique power is acting as a fiduciary.
Fiduciary. Meaning
They can legally act on behalf of others in positions of trust, like being the executor of someone's will, managing their estate after they pass away, or acting as a trustee, managing assets held in a trust for beneficiaries. That's their special niche.
Managing money based on legal trust duties.
Yeah.
Got it. Insurance companies. How do they fit in as intermediaries?
Well, their main job is pooling risk, right? You pay premiums, they protect you financially against losses, but they take all those premiums and invest them.
Right. They manage huge pools of capital.
Exactly. And specifically, life insurance companies in Canada can offer something called segregated funds. These are investment funds with some insurance guarantees built in, like protecting some of your principal.
So a mix of insurance protection and investment management. Interesting. What about consumer and sales finance companies?
These guys specialize in providing loans, often installment loans, directly to people or businesses, frequently for buying specific things like cars or appliances. Think of the financing offered right at the car dealership.
Okay. And the source mentions they often charge higher interest rates.
Typically, yes. They often lend to borrowers who might be seen as higher risk or can't get loans from traditional banks, so the higher rate reflects that higher risk.
Makes sense. Finally, pension funds and investment funds, mutual funds, ETFs, they manage massive amounts of money.
Absolutely huge. Their key role as intermediaries is pooling savings from millions of people and investing it across a wide range of assets, stocks, bonds, real estate, everything.
Diversification is the key benefit there.
That's the main practical takeaway for the individual saver. By pooling money, you get access to professional management and diversification you likely couldn't achieve on your own.
Right. And the source notes that for many Canadians, the first investment is often something simple, like a GIC from a bank or a term deposit from a credit union. Why is understanding all these different institutions so important?
Because they're not all the same. A GIC from a big bank might have different rules, rates, or penalties than a term deposit from your local credit union. Understanding these nuances, the regulations, the product features, the target clients is crucial if you're advising people financially. You need to match the right institution and product to the client's specific needs. It's not one size fits all.
Tailored advice requires knowing the landscape. Makes perfect sense. Okay, so we have the players. What about the invisible plumbing that makes it all work? Clearing and settlement. Let's talk about CDS.
Right. CDS Clearing and Depository Services, Inc. Hugely important, but most people never see it. Its main job is to track all the buy and sell orders happening every day. And then it does something called netting.
Netting. Okay, what does that actually mean in practice?
Instead of every single buy and every single sell triggering its own separate transfer of cash and securities back and forth, which would be incredibly cumbersome, CDS calculates the net position for each dealer or institution at the end of the day.
Can you give an example?
Sure. The source uses Enbridge shares. Let's say dealer A buys 1,000 Enbridge shares from dealer B during the day, but dealer A also sells 600 Enbridge shares back to dealer B.
Okay, two separate sets of trades.
Right. Without netting, you'd have 1,000 shares going one way, 600 shares going the other, plus all the cash movements. CDS nets it out. The net effect is just 400 shares moving from dealer B to dealer A and one net cash payment.
So it massively simplifies the number of actual transfers that need to happen.
Exactly. A huge reduction in volume.
So why does this matter to me, the individual investor? What are the benefits of this netting and clearing process?
Several big ones. First, speed. It makes that T+2 settlement possible trade Monday, cash and shares move by Wednesday. Reliable and fast.
Okay, speed. What else?
Reduced risk. Fewer transfers mean fewer chances for errors, delays, or one side failing to deliver. It makes the system much safer.
Safer, faster.
More liquidity. Because settlement is quick and reliable, people are more confident trading frequently. They know they'll get their cash or shares promptly. That keeps the market moving.
Right, encourages activity.
And overall, it just builds market confidence and stability. You sell something, you trust the money will be there in 2 days. You buy something, you trust the shares will arrive. CDS underpins all of that.
The unsung hero, keeping the pipes clear.
Yeah.
Okay, fascinating. Now, let's look ahead. The industry isn't static. What are the big forces reshaping the Canadian securities market right now? Fintech comes up first.
Yeah, fintech financial technology is huge. It's basically using tech, software, apps, AI, online platforms to deliver financial services differently, often better or cheaper.
We see it everywhere.
We do. Startups and established players are all using tech to offer new products, streamline processes, reach customers in new ways.
And what's the concrete impact on clients? The source gives an example.
A really good one. Someone new to Canada, maybe with no local credit history, can go online, apply for a small line of credit through a fintech platform, and get approved in minutes. No need to even visit a bank branch.
Wow, that's a big change in accessibility.
Huge. Plus, things like e-wallets for payments, AI tools for basic budgeting advice, or even investment suggestions. It's changing how people interact with finance.
Definitely more convenient, potentially more personalized too, and another big trend. Robo-advisors, how are they fitting in?
Robo-advisors are those online platforms that use algorithms to build and manage investment portfolios for you, usually with low-cost ETFs.
Automated investing, basically.
Essentially, yes. You answer questions online about your goals, timeline, risk tolerance, and the platform builds and automatically rebalances a diversified portfolio for you.
In the example for this?
The source mentions like a 25-year-old teacher, maybe with $5,000 to invest. They can set it all up on their phone, get a globally diversified ETF portfolio managed for them, often for much lower fees than a traditional advisor.
So great for accessibility, especially for younger or smaller investors. Makes sense. What about demographics? How are population changes impacting things?
Two big shifts happening. First, the baby boomers are aging, hitting retirement. So there's a growing demand for income-focused products, retirement planning services, things to help them live off their savings.
Okay, the retiree wave.
Right. And second, you have the millennials, a huge generation, often dealing with significant debt, student loans, mortgages. So their needs might be more around budgeting, debt management, maybe getting started with saving later than previous generations.
Different generations, different financial priorities, clear. There's also the shift from DB to DC pensions. Explain that one.
Okay, DD is defined benefit. Your employer promises you a specific pension amount in retirement based on salary and years worked. The employer takes the investment risk.
The traditional pension.
Right. But the big shift is towards DC defined contribution. Here, you and maybe your employer contribute to your individual investment account. Your retirement income depends entirely on how much goes in and how well those investments perform.
So the risk shifts.
Entirely to the employee. You bear the investment risk. That makes financial literacy, understanding diversification, long-term planning absolutely critical for individuals now. Much more personal responsibility.
A really fundamental shift. The source also mentions low savings and high household debt in Canada. How does that broader economic picture play in?
Well, if many people are struggling with debt and don't have much saved, advisors often find they need to start with the basics.
Like before even talking about investing.
Exactly. Prioritize building an emergency fund first. Get a handle on debt repayment strategies. You need to build that solid financial foundation before you can really focus effectively on long-term wealth building through investing. First things first.
Build the base before the tower. Got it.
Yeah.
Education and credentials for advisors are also mentioned as a trend. Why is that becoming more important?
Because the financial world is getting more complex. New products, new rules, fast-changing tech. Clients increasingly want advisors who can prove they have the knowledge and ethics to navigate all that.
So designations matter more.
Yes. Things like the CFP, Certified Financial Planner, or CIM, Chartered Investment Manager, signal a higher level of expertise and commitment to professional standards. It builds trust and credibility in a crowded market.
Makes sense. Finally, crypto assets. Bitcoin, Ethereum. How are they shaking things up?
Well, they're a whole new alternative asset class operating largely outside the traditional system, still very volatile, lots of regulatory questions.
But gaining traction.
Definitely gaining acceptance. We now have Bitcoin ETFs and similar products in Canada, which lets traditional investors get some exposure within a regulated wrapper, usually as a small part of a diversified portfolio.
So you can buy it through your regular broker now, basically.
In some forms, yes, but the volatility and evolving rules are still major factors for investors and advisors to consider carefully.
Right. High risk, high potential needs caution. The source gives a balanced view on fintech and crypto opportunity versus risk for the traditional players.
Yeah, the takeaway is that these innovations bring huge potential benefits, more access, lower costs, more efficiency, democratization, you could call it.
But the risk is
Disintermediation. That traditional players might get cut out or see their roles shrink as tech allows more direct connections or automated services.
So, will the robots replace the humans?
Probably not entirely. The likely future is an evolution. The most successful advisors will be the ones who blend technology using the data, the tools with human judgment, empathy, behavioral coaching, holistic planning. That human touch, especially for complex needs and building trust, is hard to automate. It's about combining the best of both.
Human plus machine. Okay, that's a helpful perspective. Now, to tie all this together, the source uses a case study, Maria. Can you walk us through her situation and how different intermediaries help her?
Sure. Maria is 32, a professional. She has a few goals. She wants to buy a condo in about 5 years. She's saving for retirement way down the road, age 60. And she's curious about crypto.
Okay, multiple goals, different timelines. How does she start with the condo savings?
For that shorter-term goal, she puts $10,000 into a high-interest savings account, a HISA, at her main Schedule I bank.
Why there?
It's safe, easily accessible for when she needs the down payment soon, and it's covered by CDIC deposit insurance. Liquidity and safety are key for that goal.
Makes sense. What about her long-term retirement savings in her TFSA?
For that longer horizon, she uses the investment dealer arm of her bank to buy a balanced mutual fund within her TFSA. That gives her diversification across stocks and bonds, aiming for long-term growth.
Okay, different goal, different product, different intermediary structure, even within the same bank group. And a specific first home savings.
Right. She's also using the First Home Savings Account, the FHSA. For that, she chooses a robo-advisor.
Interesting. Why a robo for that one?
Maybe for the lower fees, the ease of use.
Huh?
The robo-advisor, based on her 5-year timeline for the house, puts her FHSA contributions into a portfolio of short-term bond ETFs, more conservative than the mutual fund, focused on capital preservation for that upcoming down payment.
Tailoring the approach again, and her crypto interest.
She decides to allocate just a small slice, maybe 2%, of her overall investments to crypto. She does this through the same bank-owned dealer she used for her TFSA, buying a Bitcoin ETF.
So accessing crypto through a regulated channel.
Exactly. And importantly, those Bitcoin ETF units, they settle just like any other ETF or stock through CDS on that T+2 basis. Even new assets plug into the existing plumbing.
Fascinating how it connects. And when she's ready to buy the condo in 5 years.
The investment dealer acts as her agent again. They sell the bond ETFs she holds in her FHSA. The cash proceeds go to her bank account, then usually to her lawyer's trust account to handle the down payment and closing.
Wow. It really shows how you use different parts of the system for different needs. A bank for savings, its dealer for mutual funds and crypto ETFs, a robo for the FHSA. It's layered.
Precisely. It's not always about one single provider doing everything. Maria's case perfectly illustrates that interconnectedness and specialization, different intermediaries for different jobs.
Okay, fantastic illustration. So as we wrap up this deep dive, let's quickly summarize the key takeaways.
Sure. First, remember the whole securities industry is this vital network channeling capital, and intermediaries are the essential matchmakers.
Right.
Second, investment dealers are core players. Retail, institutional, integrated, making money as agents via commissions or as principals via spreads.
Got it.
Third, it's a diverse ecosystem. Big banks coexist with credit unions, trust companies, insurers, each with a niche. Fourth, don't forget the invisible plumbing. Clearing and settlement, like CDS, are critical for smooth, safe, fast markets through netting and T+2 settlement.
Unsung heroes.
And finally, the industry is constantly changing. Fintech, demographics, the pension shift, crypto. These are powerful forces reshaping the future.
So why does all this matter to you, our listener? Well, understanding this system gives you real insight into how the financial world actually works.
Yeah, knowing the roles of the players, how money moves.
Whether you invest yourself, work in the industry, or are just curious about the economy, this knowledge helps you navigate things better, ask smarter questions, make sounder decisions.
Absolutely. And maybe a final thought to leave you with.
Yeah?
As you see fintech making things more accessible and new assets like crypto emerging, think about how that might change these traditional intermediary roles even more in the future. What new kinds of matchmaking might pop up? What does the future connection between capital and opportunity look like?
A fascinating question. Definitely something to keep watching.